No,
I think we're live on Facebook. Shows up here.
I think we might be too. Jake, we live on Facebook? Looks like we are. Hey, everybody, don't mind us. We're just here having oblivious conversation. And, it's that time again where we get to talk to somebody that has some great data and a great team to put it all together. So we, as the agent community, broker community, mortgage agent or mortgage officer community, can have a deeper understanding of our job. And David Childers from Keeping Current Matters, welcome and thank you for being here and bringing the knowledge that you do.
Thank you, Johnny. I'm excited about today. You and I were talking before about, just everything going on. And so we've got some good topics to talk about, some interest rate topics. I brought a few things for projections for next year, talk a little bit about investors and landlords. So a lot happening as we kind of close out this year and look forward to next. So looking forward to spending the next few minutes kind of going through that.
Me too. And hopefully, you know what? Somebody posted this on Facebook today and I thought it was hilarious. Next year, it's 2021. Wait until it's grown up and drunk and see what comes, right? Oh, no, stay away. But anyways,
Yeah.
we can't look at not projections per se, like what's going to happen, because we don't really have a crystal ball. But
Sure.
what we can do is look at data, and that kind of gives us an idea of a short projection of what we can expect. So I'm going to let you go right in with it. I don't need to ask any questions. We're going to talk a little bit about mortgage rates. And, often I think agents will hear things on the news like, oh, the Fed's cut the rate. And instantly they think mortgage rates are going to come down. But
Right.
that's not exactly accurate. And let's just jump right into it. I'll let you take the mic and go for it.
Yeah, let's talk about that, because I think this is a topic, Johnny, and I'm glad you brought it up, that we're going to hear, talked about in our business. We're going to hear, discussed maybe in the news or whatever we see out there. And I'm going to say, look, I don't think anybody, from an agent standpoint, need to try to become an expert in the secondary mortgage market. But I want to give you some perspective on that and where we've been this year and where we're at. So I'll share my screen here. This is a look, it's very interesting. This is a look at purchase applications. So these are people applying for, financing to buy a home on a year-over-year basis of really going all the way back to March. And what do you see here? We took the dip down and, the lockdown around March and April, and every week we've been consistently higher than the prior, the week this time last year. Very, very, strong market relative to people saying now is the time we want to buy a home. You see the little dips there in orange. Those are holiday weeks.
I got that. I was going to ask that. What?
Yeah. You see, 4th of July, Memorial Day, Thanksgiving, certainly days that dip down. And, it just underscores the strength of the residential real estate market this year. Just gives a word picture to it to show that. We used this graph last week, and the reason behind that is the 30-year fixed rate. And this goes all the way back to the first of the year, and just seeing the slide down to where we sit at 2.71% on average, according to Freddie Mac, for the 30-year fixed rate. Right now, and that's looking at where we've been is unbelievable. I'm going to talk about what experts are forecasting going into next year in just a minute, but the story and I think what you were bringing up is what Freddie Mac said this week. They said mortgage rates remain at record lows, resisting their typical correlation to Treasury yields, which have been recently moving higher. So a lot of people think, they hear about the Fed's cut rates, and actual mortgage rates follow the 10-year Treasury. And so expect to hear a little bit more about that, because there's interesting things happening in the market. If we were to go back and look at this as a graph for the past 50 years, the 30-year mortgage rate has moved pretty much in unison with the 10-year Treasury. And that spread kind of hovering there, going up, going down, wherever it's going, it's following the 10-year Treasury. And now if you listen, you'll hear people say, okay, the Treasury is starting to move upward. Okay, the 10-year Treasury, and this is what this looks like going back to October. Treasury's been on this slow, kind of increase upward, and people going, okay, are rates going up? What's going to happen in the real estate market? And so we find ourselves in a place where we can go, okay, if you want to know the future of mortgage rates, you want to start to look at the 10-year Treasury. We know right now the Treasury is going up, and yet experts are forecasting rates to remain low going into 2021. So
that's good.
An interesting market. Now, there's a nuance there that the short answer to that is the Fed is our friend right now. The Fed is buying mortgage-backed securities. Mortgage-backed securities are an attractive investment right now. And I'm going to get into this in a second. As you go into 2021, some of the projections that are being made by experts, housing is forecasted to be very strong in 2021 for a lot of different reasons. But it's kind of given us that headwind, if you will. I mean that tailwind, if you will, and pinning rates lower going into next year. And if you think back at that graph, whether we're at 2.7, 2.8, and there are some folks talking that we could dip a little bit lower. But whether we're at 2.7, 2.8, or 3%, we're still in a very, very good interest rate environment and projected to be going into next year.
I think that's fantastic. Awesome news. And it's almost like free money. I mean, when you think about it over a 30-year period, it's free money. And if you haven't pulled out, refied and pulled out some money to maybe buy an investment property, again, with low rates, they're not going to be that low. Usually they'll be a little bit higher, but you're able to basically borrow free money and buy these investments. I got a question for you, though. I know the government puts things in place. I know this isn't a pro-Trump statement at all. And I know that he's been able to manipulate things. He's a brilliant guy with money, so you can't take that away from him. But he's been putting some things into place that have pushed the interest rates or help push the interest rates, or restructuring different things at Federal Reserve, nationalizing Treasury, these kind of weird things that I quite frankly don't understand.
Sure.
But is the government currently, the current administration, in any way, shape, or form holding back inflation and keeping these rates low? And what happens if the rates really start to skyrocket? Does everything else start to skyrocket too? And is that where we see the term hyperinflation come in?
Well, I think that's the question going forward on many people's minds, is what is inflation going to do going forward? Now, I think regardless of the administration, what the federal government knows is that housing is a driver in the economy, right? So whatever they can do to, one, we talked about this throughout the pandemic, whatever they could do to avoid a housing crash, I believe the federal government is going to do that, right? And act quickly and act, to that degree. And we've seen that this year. And that's been the reason to avoid that. And as we go into next year, I think you can expect that to continue. At KCM, and I've mentioned this before, we've written and reported on, the impact of housing on the economy. The average new home, and I think I don't know if I mentioned this to you, the impact of a new home sale in this country is $88,000 on average in the economy and ancillary businesses. And that's the reason the federal government is driving this forward, because housing, the economy will not return in, past recessions until housing returns. And what we've seen in this is housing leading the way. And it's interesting. I was looking back on some things that we were saying, what experts were saying on the front end of the pandemic, and they were saying just that: expect housing to lead the way out of this. And I think we have to keep that in mind. The other thing we have to keep in mind is this has been a recession where there's nothing fundamentally broken in the economy. Mm-hmm. This is the fallout from a health crisis and shutdown and all the things that we know, not because there was a lending crisis like back in 2008 or, oil crisis, whatever the case has been in the past in this country. So it's very, very unique relative to that.
Yeah. And it's interesting, and I just want to break this down for people who are listening who may have missed it or may not understand it. The old number that I used to use was 84,000 85,400, I think was the number. You said 88,000. So the same thing. And basically what that means is for every sale, there's about $88,000 in incomes that are generated for underwriters, appraisers, real estate agents, and you're worth every penny. Don't cut your fee. Mortgage people, all the ancillary services to make that thing come to. It's $84,000, and that's why you see some brokers and franchises trying to get into the big pieces of the pie, which are the mortgage and the real estate and the title, because there's a big chunk of that 88,000 that's there, which I know this is completely off script and I don't even know if we want to go down it, but ICE, International Exchange, whatever they stand for, bought Sallie Mae. Was it Sallie Mae?
I'm not sure.
Earlier this year for like $11 billion or something ridiculous, because
you mean Ellie Mae?
Ellie Mae, is that who they bought?
They were sold for, I believe it was $11 billion.
Yeah.
Mm-hmm.
Buys Ellie Mae, and I think it's ICE, International. Yeah, ICE, International something exchange, Intercontinental Exchange, and they own like the New York Exchange and a bunch of other exchanges. And what they say is we can make the mortgage happen in 2 weeks for like $2,500, where it takes traditionally 6 weeks, and it costs like $8,500. I know we're going down a completely different path here, and we're not prepared to talk. It's kind of a curveball. But is there anything out there that how that sale could impact mortgage rates or the process at all?
No, I don't know. Ellie Mae is the predominant LOS on the market. Most of the deals, I shouldn't say most, but the majority of deals, they're the largest player in that of residential loan applications, and that's what the system they're going through. I think that, Johnny, your reference is that settlement services, there's a lot of opportunity. There's a lot of people vying for that business right now, and they see that business, is very, very attractive. The impact on that on rates, I think, as you look forward, and I mentioned, Freddie Mac's forecast going into next year, rates 30-year fixed remaining around 3%. I can tell you this, I've seen NARS, MBAs, Fannie and Freddie's, and they're all right around 3%. And we're gonna have to wait and see what the year brings, but the tailwind that's being provided into housing, certainly keeping pinning rates low is forecasted to continue.
Yep. And I just saw something, Elon Musk made it official, right? Moved to Texas. I would only imagine that he's going to be asking his employees to follow him and everything like that. So that's going to be a whole interesting thing to track over the next several months. Does it have an impact? And are other companies going to follow suit, or other people going to follow suit? And one of the things that I was reading and some people I was talking to is with Silicon Valley, that their employees were able to basically move anywhere they wanted. So some people moved to Lake Tahoe, some people moved to all these other areas, and now they're comfortable working from these places. And these companies are saying, we can save millions of dollars a year on rents and everything else like that, and we're getting more accomplished working remotely. So that's a whole thing.
I think that's the question, and let me set it up this way, because it really leads into 2021 projections, for our business and what experts are saying right now. And I think the thing I would say is, you mentioned before, we don't have a crystal ball. There's been so much of this year that we don't know what's going to happen tomorrow, let alone a month or two, or 12 months from now. I think the interesting thing is we can begin to formulate that relevant market opinion, and you've talked a lot about this, Johnny, on understanding insights, understanding the data, so that you can then relay those to your clients. And if the experts change, we're going to bring that to you, right? We're not saying experts aren't, are always going to be 100% right. But let me go into a couple of things, because it hits on that exact topic, Johnny. And I'll start here with a quote from Jed Kolko, the chief economist at Indeed. And he's talking about the overall economy. He understands this. He understands our business, but he's saying this above all. The 2021 outlook for the economy, is what he's talking about, hinges on the course of the coronavirus. Both the recent virus surge and the election make government emergency relief more likely. We're hearing a lot more of that, and seems very likely at this point, stimulus. He also goes, next year we'll start to show whether two big pandemic shifts will endure from services to goods and from in-office to remote work. even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, and where people live and how much they earn. So back to your point on businesses moving in states, out of states, things like that. We started this pandemic and a lot of us, I thought, or a lot of talk was, are people going to work from home now? Are people going to be required to go back in the office? Almost like there was one of two options. And I think what you're going to see is a lot form in the middle. I'm going to call it kind of the hybrid option of, maybe you have to come in to work a couple of days a week, or maybe, we're working on something else, which then gives people certainty. And they say, okay, my employer is moving or my employer is doing this. Now I can make a decision on housing. And as we get more certain about what that looks like, that will impact people's, behavior and their behavior relative to buying a home, buying what they need if they've been in limbo and don't know what that's going to look like. So I think it's a good point, and I think we're going to see more of that going into next year. If I continue on for just a minute on these forecast, we're starting to get home price forecast, and they come in two ways right now. A 12-month forecast starts to come in the fourth quarter, and we get 2021 forecast. If we kind of take outliers out of both sides of this, on average, experts are calling for, I'm going to call it 3 to 4% appreciation going into next year. Not as much as what we've seen this year, but still strong appreciation. And there are a lot of reasons for that. Many experts expect more inventory to come on the market next year as people feel safer and feel like they can, list their home. There will be people that will be impacted by the pandemic and, have to list a home for sale through this. There'll be a number of things. Builders, we talked about this last time we were together, Johnny. Builders are optimistic. The last 3 months, builder confidence has been at a record high. They're bringing more inventory. We know the leading indicators of starts and permits are exceeding last year at this time by about 30%. So a lot of things happening in housing looking into next year, forming a very attractive picture for what's in store.
Yep. And Michael Tazaro mentioned, he said in the Q&A here, he said, yes, they can work anywhere, but many companies are now telling these people that salaries will be adjusted to the area they're moving to. So many Silicon Valley workers are reconsidering leaving the area since their incomes may be adjusted.
Interesting.
That's an interesting point for sure. What does this all do for the rental market? Do we know what's going on with the rental market? Do we have an absence of rentals? I know that we're talking before we went live about potential moratoriums and who bears, the brunt of that and everything. And do you have anything on how all this impacts rentals or at all, or anything to say on that?
Yeah, I think that is a question going into next year. I do have one piece of information I'll share with you. It's a study from the Urban Institute that was just released. But before that, I think this hinges, Johnny, on the questions we talked about last week. And, as we turn the corner to the new year, Keeping Current Matters, we're going to stay on top of this. It all hinges around, moratorium of foreclosure and, forbearance, all the things that people need. And it's people that need help, and maybe mom and pop investors that got to pay the mortgage, on a place that they're renting out. Let me share this study with you real quick, and we can talk about that. It comes out of the Urban Institute. It says, as a result of the increased financial burden from the COVID-19 pandemic, more and more landlords are feeling pressure to sell their properties. Nearly 31% of responding landlords said they had felt more financial pressure to sell their properties during the pandemic than before the pandemic. Landlords who feel increased pressure to sell often face a combination of missed tenant payments, high expenses, high vacancies, and lower outside earnings. So this is certainly a story that is starting to develop, is the impact on, I'm going to call it the mom and pop investor right now, that may own one or two units that maybe feeling the squeeze during the pandemic. And, I think that's the one thing that we want to look at and say, okay, how is that going to affect these people? Because it's a challenge on both sides, renters that need help, investors that need help. And that's the question. How's that going to all play out?
So last time we were together, I made a suggestion saying, based upon, the defaults and the people that are behind it, there's your niche to go after. You just mentioned another one. So I hope people look at this stuff. go after the mom and pops, right? If they bought it and they're up some equity, but sell it. Sell it. Talk to them about selling. How can they roll that money over, protect that money against capital gains? And a lot of these mom and pops, they bought these things, these investments, because that's their retirement, right?
Yeah.
So, be versed in that area and know what you're talking about. But if you have one unit and a two family, and one person's not paying, that's a 50% reduction in your gross receivables. How are you going to carry that? I mean, I think we're probably close to the top of the market for right now. I mean, should it completely continue to go up? Don't know. Could it go down? What goes up comes down. But if they bought this thing 4, 5, 6, 7, 8 years ago, there's a good chance that there's good equity in that property, that they can take that equity and do something other with and roll it so that they don't get those implications. So,
yeah, I want to go back to a couple of things that you said there. One, I want to, on appreciation for sure. There are no experts right now calling for depreciation. Okay, experts are saying we're probably not going to appreciate as fast in the market. Now, what does that look like in real terms? And in a fast-moving market, there are a lot of people trying to price and catch the market, right? Now, as that starts to cool, then that's where we start to have folks that are like, well, can we not get that price for our home? Now, the second thing, I think in all the data, and I was on a call with our team Wednesday of this week, our research team, where we were just going through everything. And the one thing that's becoming apparent right now is the star of the 2020 housing market overall is equity. Okay, it's the equity that people have had to help them weather the storm financially, whether going through a cash out refi or whatever it was that literally wasn't there back in the housing crash. And it's the equity. You mentioned these investors that bought at a time that they were able to buy it right. And liquidating some of that will be very good in some cases for some investors. So I think the moral of the story in rising home prices is rising equity. And it's done a lot for people, and it's the value, truthfully, of home ownership. People having access to that to start a business, send a child to school, invest. Whatever the case may be, and in equity, I think as we look back on this. Is going to be the thing that people look at and go, okay, that was really the difference maker in this recession, in this downturn.
Sure, absolutely. And it's an interesting point is I think it was 2011. I went to Keller Williams family reunion in Orlando. If it was 2010, 11, somewhere right around there. But when they do the State of the Union or address or whatever they call it, right? Which is the reason everybody goes, it was for this, for this one speech. I mean, and you can only imagine how much it costs for a company or any company, but we're talking about Keller Williams, to get a report like this done, right? Hundreds of thousands of dollars, if not maybe even approaching to $1 million. You're talking about big, huge economic studies. And what they said was the experts at the time, this is why it's kind of hard. You can look at the projections. What they anticipated then was that the market was going to continue at a normal, healthy appreciation rate under 3.5%. And then 2019-ish, there was going to be a price correction. That's what they didn't call it a crash. They called it a price correction. But we're 2 years past that, and we're way above that, right? So it's really interesting to take a look at what they said then compared to where we are now. And well, what are they saying now? But all the experts are seeing that healthy appreciation. And there has to come, I mean, the health crisis, nobody asked for that.
Sure.
But there has to be something. And while that might have kicked us in the stomach a little bit, I don't think it took us out at the knees like the mortgage crash did, because there was malicious intent behind some of the things that they did. And that's what took our knees out. I don't foresee any of that or an economic crash at all. Do you? Or or the soothsayers, do they see anything?
Well, I think most people do. And we talked about this last time, the data does not show fundamental issues in that. Even, we did a study, and I can't remember, did we talk about pricing last time when we were together?
We talk about a lot of things.
Yeah. Certainly prices are rising at a very quick rate. If you go back to 1991, the average appreciation on a home in this country is 3.8%. We're wrapping this year up at 7. Interesting thing, since 2012, it's been 6.1%. So we've seen, to your point, we've seen appreciation coming out of the last 8 years that we haven't seen typically in this country. Yeah. Now, why is that? That's what we have to look at are the economics. Again, we talk about this a lot of the supply, the lack of supply is what's driving prices up. And you better believe builders are coming back. Builders were severely impacted coming out of the housing crash, and really, probably haven't had a focus on bringing new product to market like they've had this year. So when you think builders bringing homes and inventory to market, you think about people that made a decision not to do something this past year, you put their home on the market, whatever the case may be, and you see the potential fallout from those impacted by forbearance, those mom and pop investors we just talked about. Most experts are saying, okay, there's going to be more inventory come to market next year, and that's what's going to have the impact on prices. Now, the way to do this is to say, okay, what's happening in my local market? How does that look? And continue to stay on top of this so that you can show people, what's happening. But that's the main driver that I can see from experts right now that is going to, I'll use the word temper appreciation going into next year. Not calling for depreciation, just not quite as much as what we've seen this year.
Awesome. And Jake told us that's our time. And I tell you what, it's the best half hour of the week to get to talk with you and hear about the things that are happening. Again, everybody, I hope you picked up on that little nugget. Look for the mom and pops. Is it time to sell? And you can help them out of a situation before it becomes too late. Just be knowledgeable and do it for goodwill. Don't do it for the paycheck, because when you do it for goodwill, it's great. When you do it for the paycheck, it's about the paycheck. Any final words, Mr. Childers?
I think there's an opportunity. You hit the nail on the head there, Johnny. There's an opportunity to help people through this, and that's our job. So I think using this information, being out in the market, talking about it. So if there is somebody effective, there is a mom and pop investor that we can say, okay, let's look at what you have and let's try to help you make the wisest decision for you and your family going forward. And that's our job.
So everybody, the failure rate in this business is, they say 87%, 13% is the success rate. Be the 13%, get the data, look like a smart person, know what you're talking about, be the professional, and you can get that from keepingcurrentmatters.com. Is that correct?
That's it.
For the price of lunch.
Yeah, we always say if you find somebody cheaper to do it, let us know. We might subscribe to their service. So it's great information. And Johnny, as always, thank you for your support and everybody at Lab Coat Agents. And we're grateful for that. Any way we can help, let us know.
Awesome. Appreciate your time, everybody. Be safe out there. And if we don't talk to you, Merry Christmas.
Take care, guys.